There's an asset class that could have protected your portfolio during some of the worst market crashes in history. It tends to shine exactly when traditional stocks and bonds struggle the most. Today we're going to talk about that asset class and whether you should have it in your investment portfolio. So for the sake of time, let's dive right into it. Hey, this is Brian, and you're listening to the Wealth Decisions Podcast, where we talk about money, meaning, and mindset, all to help you live a richer life. If you're just tuning in, please like or follow or share the episode if you enjoy it. It helps me reach more listeners. Today we're going to talk about a question I get all the time from clients. Should I invest in gold or should I invest in silver? We're going to talk about commodities and whether they have a place in your investment portfolio. The most common commodity that people talk about the most is gold. And maybe you've seen some of the commercials on TV or videos on the internet, or maybe even received some crap in the mail. They predict economic instability and they use graphs of past performance to prove gold, silver, or some other precious metal is not only your safest bet, but is destined to double or triple in value. The truth is, gold and other precious metals are highly volatile, and past performance is not a good predictor of future returns. They're driven by fear and greed. And if sales pitches typically have some type of doom and gloom or high pressure sales tactics, it's probably some type of scam. Gold is a commodity that trades based upon supply and demand. There's no earnings. It's all about what someone else is willing to pay for it. And deciding whether or not to buy gold now depends on your individual financial situation, your investment goals, and your risk tolerance. And some reasons to consider buying gold potentially is it is considered a safe haven. When times are tough, when the fear is high, like we had last month, gold is often seen as this safe haven. And any type of political uncertainty or economic uncertainty, they tend to hold its value and sometimes increase when other assets are declining. Gold also provides some diversification. They're lower correlation to stocks and bonds, and it can potentially reduce your overall risk. Gold can also act as a hedge against inflation and potentially maintaining its value during periods when purchasing power declines because of inflation. So when things get rocky in the world, like right now, gold can perform well. For the first quarter of 2025, the Spider Gold Fund was up about 15.3% versus the S&P, which was down about 2.6%. And when it comes to other commodities, these are raw materials, sometimes agricultural products that can be bought and sold, things like gold, silver, natural gas, wheat, corn, and copper. They're really the building blocks of everything, we use in our daily lives. So commodities are another asset class that a lot of investors tend to ignore, but they can be a nice diversifier. It certainly shouldn't be a place where you try to time the market and go all into gold because you're fearful of the markets, but it can be a nice diversifier in an asset allocation model. They tend to, like I said before, have low correlation with traditional assets. That means when stocks and bonds zig, commodities sometimes will zag. And when you look at commodities often perform well during inflationary periods, like I mentioned before, exactly when other types of asset classes struggle. But like I mentioned before, commodities can be extremely volatile. Take oil prices in 2020, for instance. They actually went negative briefly during the pandemic. That's right. Traders were paying people to take oil off their hands. And this extreme volatility is why I never recommend going all in on commodities. But what's the sweet spot? Research suggests that a 5 to 15% allocation to commodities can provide some meaningful diversification benefits without, taking on too much risk. The exact percentage obviously depends on your personal situation, your risk tolerance, and investment, timeline. So let's just talk a little bit about how to invest in commodities. You certainly could go buy a gold brick and put it in your safe, or some silver coins and stick it in your safe. Or you can buy commodity ETFs that track broad commodity indexes. You certainly can buy a gold ETF or a silver ETF or some type of broad-based commodity ETF. You could also buy stocks of companies that produce commodities. You could potentially even invest in futures contracts, but I generally don't recommend these for most individual investors due to their complexity. And when you look back at performance of gold, there's periods of time where gold does pretty well. In fact, gold has actually performed really well over the last 19 years. But it's usually during periods of heightened fear where gold will perform well for a period of time. I don't really consider gold to be a long-term investment that you can just buy and hold and forget about. But certainly having a more broad-based approach by investing in a commodity ETF can be a great diversifier. We have a lot of volatility in these types of commodities, but they can be a way to reduce the risk of your overall portfolio. But commodities are not like stocks. There's no earnings growth. There's nothing underneath it except supply and demand. There's a lot of factors that can influence the performance of a commodity. It can be global economic growth, inflation, geopolitical events, supply and demand dynamics with specific commodity markets, and they all act a little differently depending on what's going on in the world. An agricultural type commodity can be impacted by the weather, and we can't predict the weather. In fact, the weatherman here in Minnesota said that we were going to have a tornado. There was tornado watches. It was all over the Facebook and social media that we were going to have this horrible tornado. Well, it never happened. So commodities can be influenced by a lot of different things. You may already own some commodities in one of your mutual funds or ETFs in a small amount. Some broad-based ETFs will have some gold mining companies or silver or copper mining companies or energy-related companies that are digging for oil. So if you want some exposure to commodities, I recommend starting with some type of broad-based commodity ETF. And this will provide exposure to a diverse basket of commodities. You're not betting on gold or silver or some agricultural market. You're investing in a ETF that's broad-based, covering all those areas, just like buying an individual stock. Because ETFs, exchange-traded funds, are listed on the exchange, and you can buy them and sell them throughout the day. So here's some actionable steps you can take this week. Review your current portfolio and calculate how much you have in commodity exposure. This is a little bit more difficult than just finding out if you have a large cap fund or growth fund or mid cap value or small cap value, or how much you have in international. Research broad-based commodity ETFs. Look for funds with reasonable expense ratios. Commodity funds tend to have expense ratios a little bit higher sometimes, but look for a commodity ETF that has an expense ratio under 0.3%. And start small. If you decide to add commodities as a diversifier to your portfolio, consider starting with just a 5% allocation and monitoring how it affects your portfolio's overall performance. Just always remember, diversification isn't about picking the single best performing asset class. It's about building a portfolio that can weather any economic storm. And commodities can be a powerful tool when used appropriately. How much you should have all depends on your particular risk tolerance and stage in life. But commodities can be a great diversifier to lower the volatility and have less correlated assets that give you broad diversification. So that's it for today's episode. Should you own gold or other commodities in your investment portfolio? Tune in next week where we're going to be wrapping up this series and this season of the Wealth Decisions podcast, where we talk about the types of asset classes and whether you should own them. I hope you enjoyed this episode, and please tune in next week. Would love if you pre-ordered my new book, Momentous Decisions, 7 Steps to Better Health, More Wealth, and a Richer Life. This has been a long lifetime goal of mine to put out a book. It's everything I've learned about habit change, health, wealth, and life, all wrapped up in one book with a 7-step plan to help you live a life closer to exceptional. If you'd like to pick up a copy of the book, you can go to momentouswealthadvisors.com/book, and at the bottom of that page there'll be a pre-order link, and it'll be out sometime in early August. And if you like this episode, please rate the episode, make some comments, and hit the notification bell to get updated on future Wealth Decision podcasts. And please, if you could, share it with a family member or a friend. My goal with the Wealth Decisions podcast is to reach over 100,000 people by the end of the year in the Twin Cities and beyond, so that people can make better wealth decisions to live a richer life. If you'd like to schedule a discovery call with me, you can go to my website at momentouswealthadvisors.com. And I'll spend some time to get to know you a little bit and find out if I might be able to steer you in the right direction or help you with your financial future. And once again, thanks for listening and have a great weekend.